How much deposit do you need for a self-build mortgage in the UK? If you're thinking about building your home, one of the very first questions you'll ask is how much deposit do I actually need? Do I need hundreds of thousands sitting in cash before I even start? And if you've been searching online, you've probably seen a wide range of answers. That's because self-build mortgages don't work like standard residential mortgages, and the way deposits are calculated often surprises people. Let's start with a short answer. For most self-build projects in the UK, you should plan for a deposit in the region of 20 to 25% of the total project cost. That doesn't mean that everyone needs exactly 25%. The exact amount that works for your personal situation can be discussed with an expert, such as us at Mayflower Mortgage. But if you're budgeting and trying to sense check whether your plans are realistic, 20 to 25% is a sensible expectation to start with. The key point where many people get caught out, however, is that this should represent 20 to 25% of the total project cost, not just the land price or the build price, but the full picture of what you want to borrow. We'll unpack that properly in a moment. So, why are self-build deposits higher than standard mortgages? To understand why the deposit is typically higher than a normal residential mortgage, you need to understand risk. With a standard mortgage, the lender is lending against a completed property. It exists, it can be valued, and it can be sold if necessary. But with a self-build, the lender is lending against a plot of land, a set of drawings, a projected end value, a construction timeline, and a cost plan. The finished house doesn't exist yet. That means there are more moving parts. What if build costs increase? What if the project stalls? What if the final value isn't what was expected? What if there are delays or complications? From a lender's perspective, that's additional risk during construction, and the deposit is one of the key ways that risk is managed. The more you put into the project yourself, the more financial buffer there is. It demonstrates commitment, resilience, and the ability to absorb unexpected costs. This is why you'll often find self-build loan-to-value ratios are lower than standard residential mortgages. So how is the required deposit calculated? In most cases, the deposit is calculated as a percentage of the total project cost. For example, land, £150,000, build costs, £250,000, professional fees, surveys, warranties, contingency, £50,000. That would mean the total project cost is £450,000. If you're working on a 25% deposit expectation, that would be 450,000 times 25% equals £112,500. We've seen this surprise a lot of people. Sometimes there's a misconception that it's 25% of the land cost only, which would only be £37,500 in this example. But self-build lending is based on the entire financial picture, not just the plot purchase. That's why it's so important to cost the whole project realistically before trying to calculate the deposit. Of course, working with a specialist is the best way to understand how this can look for you and what the right deposit would be. So if these figures are sounding confusing, you can book in for a free call with Mayflower today. Why does the total project cost matter so much? Lenders aren't just looking at what you're buying today, they're looking at what the finished property will be worth and how much is being invested to get there. That includes land, materials, labour, structural elements, professional fees, warranty costs, site insurance, and contingency. If you underestimate your total project cost, you may also underestimate your deposit requirements, and that's where projects can start to feel financially stretched. This is why strong costings early on are so important. At Mayflower, we offer a complimentary, fully costed schedule of works for all our customers that outlines your total costs right down to each screw. So that's one less thing to worry about when you're working with us. Are there exceptions to the 20 to 25% deposit aim? Finance is always personal to your circumstances, so while 20 to 25% is a realistic expectation for many projects, there are situations where lenders may expect more. For example, non-standard construction methods, very rural or hard to value locations, complex planning conditions, aggressive build budgets, tight affordability margins, previous credit challenges, limited cash reserves. The more complex or unusual a project appears, the more caution is built into the lending structure, and that often shows up in the required deposit, but there are other ways to prove affordability too. Can you do it with less than 20%? Sometimes, but it depends heavily on the strength of your income, the strength of your credit profile, the quality and location of the plot, the realism of your costings, and the projected end value. If everything about the project looks stable and well planned out, you may have more flexibility. However, if you're building your entire financial plan around a 5% deposit assumption, you may find that options are more limited than expected. For planning purposes, it's far safer to model your numbers around 20 to 25% and treat anything lower as a bonus rather than a guarantee. But do I need the full deposit as cash? When we talk about deposit, people often imagine a lump sum sitting in savings, but we've worked with many clients who've made funds up from a combination of cash savings, equity in an existing property, proceeds from a sale, available funds in their own business. If you own your current home and you have built up equity, that equity can form part of your deposit contribution. For example, if your current property is worth £400,000 and you have a £200,000 mortgage remaining, you have £200,000 of equity. That equity could potentially be used to fund your land purchase and contribute towards your overall deposit. This is circumstantial, so it's best to speak to an expert early on so you can properly understand your options. Do you sell or keep your current home during the build? This ties into a much bigger strategic question. Do you sell your current home before you build or try to keep it during the project? Selling can release equity, reduce financial pressure, simplify your borrowing structure. Keeping it can provide stability, avoid rental disruption, but increase financial strain. There's no universal answer. It depends on your risk tolerance, cash flow resilience, and comfort with carrying two financial commitments. As always, the key is proper planning, not reacting halfway through the build. Deposits also affect your interest rate. Generally speaking, the lower the loan to value, the lower the perceived risk. Lower risk can mean broader product choice, potentially more competitive rates, and greater flexibility. If you're borrowing 75% of your project cost, that's very different from borrowing 90%. Even a small increase in deposit can sometimes meaningfully improve your overall financial position, but it must be balanced with maintaining enough liquidity to manage the build, which brings us to something even more important than the deposit itself. A deposit is only one piece of the puzzle. You can technically meet a 25% deposit requirement and still feel financially stretched during your build. Why? Because self-build mortgages release funds in stages. You need cash flow between stage payments, buffer for delays, contingency for cost increases, funds for living expenses. And this is why we often say, don't just calculate your deposit, calculate your resilience. So here's a simple framework to sense check your position. Step 1. Calculate your full project cost. Include land, build materials, labour costs, site infrastructure, professional fees, surveys, warranty, insurance, landscaping, contingency. Be realistic because optimism is expensive. Step 2. Apply a 20 to 25% range. Multiply your total project costs by 20% for a lower expectation or 25% for a more conservative planning number. This gives you a safe working range. Step 3. Identify your available contribution. Add together cash savings, equity from property, any confirmed capital you're willing to use. Be honest about what you're comfortable committing here. Step 4. Check your cash flow. After your deposit is paid, will you still have a contingency buffer, funds for stage payment gaps, money for living costs? If the answer isn't a yes at this point, it's especially important to speak to a specialist to review your situation and your options. Either way, if you want to understand what this looks like for your specific project, the most valuable thing you can do is run the numbers properly before you commit to land. A clear financial plan at the beginning prevents stress halfway through, and that's where your experience really makes a difference to your self-build journey.